You know that feeling when you see someone on social media posting about their passive income streams, claiming they're making thousands of dollars every month while sipping coffee on a beach somewhere? And you can't help but wonder if they're telling the truth or if there's some massive catch you're missing. Well, I'm about to pull back the curtain on exactly what it really takes to generate $2,000 per month in genuine passive income. And I guarantee some of these numbers are going to shock you. My name is Alex, and I spent over a decade in investment banking before I walked away from that world in my mid-30s. These days, I spend my time studying finance and wealth creation, and I mentor people who want to build real, sustainable income streams. If you're tired of the get-rich-quick schemes and you want to understand the actual mathematics behind passive income, make sure to hit that subscribe button and give this video a thumbs up if it helps clarify things for you. Now, before we dive into the real numbers, let me ask you something. When you think about passive income, what comes to mind? Maybe you picture rental properties that magically pay you every month without any work on your part, or perhaps you imagine dividend stocks that shower you with cash while you sleep. The truth is, most people have completely unrealistic expectations about what passive income actually looks like and how much capital you need to generate meaningful amounts of it. Here's something that might surprise you. The person bragging about their $2,000 monthly passive income probably had to invest somewhere between $400,000 and $1.2 million to make that happen, depending on their strategy. And that's assuming they're using relatively conservative, time-tested approaches rather than some risky scheme that could disappear overnight. But here's where it gets really interesting, and this is something that most financial gurus conveniently forget to mention. There's a massive difference between gross passive income and net passive income. That rental property generating $2,000 per month might only be putting $800 in your pocket after you account for property taxes, insurance, maintenance, vacancy periods, and property management fees. Suddenly, that impressive monthly income doesn't look quite so impressive anymore. Let me paint you a picture of what the math actually looks like across different passive income strategies. Because understanding these numbers is crucial if you want to set realistic goals and avoid the disappointment that comes from chasing unrealistic expectations. Let's start with dividend investing, which is probably the most straightforward passive income strategy out there. If you want to generate $2,000 per month from dividend-paying stocks, you're looking at needing $24,000 per year in dividend income. Now, the average dividend yield on quality dividend stocks hovers around 3% to 4% annually. Using a conservative 3.5% yield, you'd need approximately $685,000 invested in dividend-paying stocks to generate that $2,000 monthly income. But here's the catch that most people don't think about. Dividends aren't guaranteed. Companies can cut or eliminate their dividends during tough economic times, which means your passive income can disappear faster than you might expect. Plus, you're dealing with dividend taxes, which can take a significant bite out of your actual take-home income depending on your tax bracket. The real estate route presents its own set of challenges and capital requirements. Let's say you want to buy rental properties that generate $2,000 per month in net cash flow. In most markets, you'll need properties that rent for significantly more than $2,000 monthly to achieve that net number after all expenses. A property that rents for $3,000 per month might only net you $1,500 after accounting for mortgage payments, property taxes, insurance, maintenance, and vacancy allowances. This means you might need 2 or 3 rental properties to generate your target $2,000 monthly passive income. With average home prices in many markets, you could be looking at needing $200,000 to $400,000 in down payments alone, not to mention the additional capital you'll need for renovations, closing costs, and emergency repairs that inevitably pop up. Here's something that really gets me about the real estate passive income narrative. People act like rental properties are truly passive, but anyone who's actually owned rental properties knows that's not entirely accurate. You're dealing with tenant issues, maintenance calls, property management decisions, and market fluctuations that can dramatically impact your returns. It's more accurate to call it semi-passive income, and even that might be generous depending on how hands-on you choose to be. Bond investing offers another path to passive income, but the numbers here are even more sobering. With current interest rates on high-quality bonds sitting in the 4% to 5% range, you'd need roughly $480,000 to $600,000 invested in bonds to generate $2,000 monthly in interest income. And unlike stocks, bonds don't offer the potential for capital appreciation that could boost your returns over time. The challenge with bonds is that they're designed to be safe and predictable, which means the returns are relatively modest. You're essentially trading higher return potential for lower risk, which might make sense for part of your portfolio but probably isn't the most exciting way to build wealth. Now let's talk about something that might blow your mind: the relationship between risk and return in passive income strategies. The investments that require the least amount of capital to generate $2,000 monthly are usually the riskiest ones. You might find some high-yield dividend stocks or REITs that offer 8% or 10% annual yields, which would reduce your required capital to around $240,000 to $300,000. But those higher yields usually come with higher risk of capital loss or dividend cuts. This is where most people get tripped up in their passive income journey. They see an attractive yield and forget to consider the underlying risks. A stock paying a 12% dividend yield might seem like a great deal until you realize the market is pricing in a high probability that the dividend will be cut or the company might face serious financial difficulties. Here's a reality check that most people don't want to hear. Building significant passive income isn't just about finding the right investments. It's about accumulating enough capital to make those investments meaningful. And for most people, that capital accumulation phase takes years or even decades of consistent saving and investing. Think about it this way. If you're currently saving $1,000 per month and investing it at an average 8% annual return, it would take you roughly 25 years to accumulate the $600,000 needed to generate $2,000 monthly in passive income using conservative dividend strategies. That's a quarter century of disciplined saving and investing before you reach your passive income goal. But here's where the math gets really interesting, and this is something that could completely change how you think about passive income timelines. The power of compound growth means that your money starts doing more of the heavy lifting as your portfolio grows. Your first $100,000 might take 8 years to accumulate, but your second $100,000 might only take 5 years because your existing investments are generating returns that accelerate your progress. This acceleration effect is why understanding the real capital requirements for passive income is so important. Once you know you need $600,000 to generate $2,000 monthly, you can work backwards to figure out how much you need to save each month and for how long to reach that goal. The beautiful thing about this approach is that it removes the mystery and unrealistic expectations that keep most people stuck in financial mediocrity. Instead of hoping for some magical passive income strategy that doesn't require significant capital, you can focus on the proven path of consistent saving, smart investing, and patient wealth building. But here's where most people make a critical mistake that costs them years of progress. They assume that passive income has to be completely hands-off from day one. The reality is that the most successful passive income builders I know started with what I call semi-passive strategies and gradually transitioned to more hands-off approaches as their capital grew. Take business ownership as an example. You might start by building or buying a small business that requires some of your time and attention initially. Maybe you spend 20 hours per week managing operations, optimizing systems, and training employees. Over time, as the business grows and you implement better systems, your involvement decreases while the income remains steady or even increases. Eventually, you might have a business that generates $2,000 monthly with minimal input from you. The beautiful thing about this approach is that businesses can often generate higher returns than traditional investments. A well-run business might produce 15% to 25% annual returns on your invested capital, which means you'd need significantly less money up front to reach your $2,000 monthly target. Instead of needing $600,000 in dividend stocks, you might only need $150,000 to $200,000 invested in the right business opportunity. But here's the catch that everyone conveniently forgets to mention. Building or buying a business requires skills that most people don't have. You need to understand marketing, operations, finance, and management. You need to be able to evaluate opportunities and avoid the countless scams and bad deals that exist in the business for sale market. Most importantly, you need the emotional resilience to handle the inevitable challenges that come with business ownership. I've seen people pour their life savings into businesses they didn't understand, only to watch their passive income dreams evaporate within months. The restaurant that seemed like a gold mine turns out to have hidden operational challenges. The online business with impressive revenue numbers was actually losing money due to unsustainable customer acquisition costs. The rental property in what seemed like a great neighborhood becomes a nightmare when the local economy shifts. This is why I always tell people that the most important investment you can make isn't in stocks, bonds, or real estate. It's in your own financial education. The more you understand about money, investing, and business, the better equipped you'll be to build real wealth instead of just chasing the latest passive income fad. Here's something that might surprise you about the timeline for building meaningful passive income. Most people who successfully generate $2,000 or more monthly in passive income didn't get there in a straight line. They might have started with dividend investing, then added some rental properties, maybe started a side business, and gradually built a diversified portfolio of income streams. This diversification isn't just about spreading risk, though that's certainly important. It's about creating multiple pathways to your income goal. Maybe your rental property only nets you $800 monthly. Your dividend portfolio generates $600, and your small business produces another $600. Suddenly, you've reached your $2,000 target without putting all your eggs in one basket. The psychological benefit of this approach can't be overstated. When you're relying on a single income stream for your passive income goals, every hiccup feels like a disaster. But when you have 3 or 4 different sources contributing to your monthly target, temporary setbacks in one area don't derail your entire plan. Now let's talk about something that most passive income discussions completely ignore. Tax implications. The way your passive income is taxed can dramatically impact how much you actually get to keep. Dividend income, rental income, and business income are all taxed differently, and understanding these differences can mean the difference between reaching your goals and falling short. Qualified dividends are taxed at capital gains rates, which are typically lower than ordinary income tax rates. But rental income is taxed as ordinary income, which means it could be subject to your highest marginal tax rate. Business income might qualify for the 20% qualified business income deduction, potentially reducing your effective tax rate significantly. These tax considerations should factor into your passive income strategy from the beginning. It's not just about generating $2,000 monthly in gross income. It's about structuring your investments and income streams to maximize your after-tax income while staying within legal boundaries. Here's a reality check that might be hard to swallow. For most people, building $2,000 monthly in passive income isn't a get-rich-quick scheme. It's a get-rich-slowly plan that requires patience, discipline, and continuous learning. The people who succeed at this aren't necessarily the smartest or the luckiest. They're usually the most consistent and the most willing to adapt their strategies as they learn and grow. I've watched countless people get excited about passive income, start strong for a few months, then lose interest when they realize it's not as easy or as fast as they expected. They bounce from strategy to strategy, never giving any single approach enough time to work. Meanwhile, the people who pick a reasonable strategy and stick with it for years end up building substantial passive income streams that actually last. The compound effect applies to more than just investment returns. It applies to your knowledge, your network, and your ability to spot opportunities. The person who spends 5 years learning about real estate investing will have a massive advantage over someone just starting out. They'll know which markets to avoid, how to spot good deals, and how to manage properties efficiently. This expertise doesn't just make you more successful. It makes your income streams more truly passive because you've developed the systems and knowledge to minimize your ongoing involvement. The experienced real estate investor can spot problems before they become expensive disasters. The seasoned business owner can delegate effectively because they understand what needs to be monitored and what can be automated. But here's something that will probably make you uncomfortable. And it's a truth that most financial advisors won't tell you because it doesn't sell courses or coaching programs. The majority of people who successfully build $2,000 monthly in passive income started with a much higher active income than they're willing to admit. They weren't making minimum wage and somehow magically creating wealth out of thin air. They were earning $80,000, $120,000 or more annually, which gave them the surplus capital needed to invest consistently over time. This isn't meant to discourage you if you're not currently in a high-income bracket. It's meant to give you a realistic picture of what you're working with. If you're making $45,000 per year and trying to build passive income, you might need to focus on increasing your earned income first before you can meaningfully pursue passive income strategies. Sometimes the fastest path to passive income is through active income growth. I learned this lesson the hard way during my investment banking days. I was making good money, but I was so focused on trying to optimize my investment returns that I ignored opportunities to increase my earning potential. Looking back, the hours I spent researching dividend yields would have been better spent developing skills that could boost my salary by $20,000 or more annually. Here's where the math gets really interesting when we talk about increasing your earning potential versus optimizing your investments. Let's say you're currently making $60,000 per year and you manage to negotiate a $10,000 raise or develop skills that land you a better job. That extra $10,000 annually, if invested consistently at 8% returns, becomes worth over $250,000 after 20 years. That's more than enough to generate significant passive income down the road. Compare that to spending the same time and energy trying to squeeze an extra 1% return out of your current investments. If you have $20,000 invested, that extra 1% only nets you $200 per year. The math is clear, but most people get seduced by the idea of optimizing their investments instead of focusing on growing their income first. But let's get back to the core question about capital requirements, because there's another angle that most people never consider. The amount of money you need to generate $2,000 monthly in passive income depends heavily on your time horizon and your risk tolerance. If you're 25 years old and have 40 years until retirement, you can afford to take more risks and potentially need less upfront capital because time is on your side. A 25-year-old might be comfortable investing in growth stocks that don't pay dividends today, but could become dividend powerhouses in 20 or 30 years. They might be willing to buy rental properties in up-and-coming neighborhoods that don't cash flow immediately, but could become gold mines as the area develops. Time gives them the luxury of playing longer-term strategies that require less initial capital. But if you're 50 years old and hoping to retire in 15 years with $2,000 monthly in passive income, you need a completely different approach. You probably can't afford to wait for growth stocks to mature into dividend payers. You need investments that are producing income today, which typically require more upfront capital and offer lower growth potential. This time horizon consideration is crucial because it affects every decision you make in your passive income strategy. The younger you are when you start, the more you can rely on compound growth to do the heavy lifting. The older you are when you start, the more you need to rely on current income production, which usually requires more capital up front. Here's something that might shock you about the relationship between age and passive income building. A 25-year-old who saves $500 monthly and earns 8% annual returns will have over $1.3 million by age 65. That's enough to generate $3,000 to $4,000 monthly in passive income using conservative withdrawal strategies. But a 45-year-old starting with the same $500 monthly savings would only accumulate about $375,000 by age 65, generating maybe $1,000 to $1,200 monthly in passive income. The difference isn't just about having more time to save, it's about having more time for compound growth to work its magic. Those extra 20 years don't just add 20 years worth of contributions, they add 20 years worth of returns on returns. which creates exponential rather than linear growth. This is why I always tell people that the best time to start building passive income was 20 years ago, and the second best time is today. Every year you delay starting costs you exponentially more than just 1 year's worth of contributions. Now let's talk about something that could completely change your timeline for reaching $2,000 monthly in passive income. Geographic arbitrage. The amount of money you need to generate $2,000 monthly depends heavily on where you plan to live and spend that money. $2,000 monthly might cover basic expenses in some parts of the Midwest, but it wouldn't even cover rent in San Francisco or Manhattan. I've seen people dramatically accelerate their passive income journey by being strategic about their location. Maybe they build their wealth while living in a high-income area, then relocate to a lower-cost region where their passive income goes much further. Suddenly, the $400,000 they need to generate $2,000 monthly becomes enough to live quite comfortably in the right location. This geographic strategy extends beyond just where you live. It affects where you invest. Real estate markets vary dramatically across the country. The same $200,000 that might buy you a small condo in California could purchase a duplex in Ohio that generates significant rental income. Understanding these geographic differences can multiply your purchasing power and accelerate your path to meaningful passive income. But here's a warning about geographic arbitrage that most people don't consider. Moving to a lower-cost area often means accepting lower income opportunities as well. You might reduce your expenses, but you might also reduce your ability to generate the capital needed for passive income investing. It's a trade-off that requires careful analysis rather than just assuming that lower costs automatically equal better financial outcomes. The key is timing. Build your wealth and income-generating potential in higher opportunity areas, then consider relocating to lower-cost areas once your passive income streams are established and location-independent. Here's something else that complicates the passive income equation. Inflation. The $2,000 monthly that seems adequate today might feel like poverty wages in 20 or 30 years if inflation continues at historical rates. A 3% annual inflation rate means that $2,000 today will have the purchasing power of about $1,100 in 20 years. This means your passive income target is actually a moving target that increases every year. This inflation reality means you need to think beyond just reaching $2,000 monthly. You need to build passive income streams that can grow over time to maintain their purchasing power. This is why I'm not a huge fan of bonds for long-term passive income. While they provide predictable income today, that income doesn't typically grow with inflation, which means your standard of living gradually declines over time. Dividend-paying stocks and rental properties have historically been better hedges against inflation because both dividends and rents tend to increase over time. Quality companies raise their dividends annually, and rental properties allow you to increase rents with market conditions. This growth potential is crucial for maintaining your purchasing power over decades. The inflation consideration also affects how much capital you actually need to reach your goals. If you need $2,000 monthly today but want to maintain that purchasing power for 30 years, you might actually need to target $4,000 monthly by the end of that period. This doubles your capital requirements unless you're investing in assets that can grow their income over time. Here's where the conversation gets really practical. Let's say you've done the math and determined you need $600,000 invested to generate your target passive income. How do you actually accumulate $600,000 without winning the lottery or inheriting money from a rich relative? The answer is both simple and challenging. You need to consistently save and invest a significant portion of your income for a significant period of time. There's no magic formula or secret strategy that eliminates the need for patience and discipline, but there are ways to accelerate the process if you're willing to make some sacrifices and strategic decisions. The most straightforward acceleration strategy is increasing your savings rate. Instead of saving $1,000 monthly, what if you could save $1,500 or $2,000? This might require some lifestyle adjustments that feel uncomfortable initially, but the math is compelling. Saving $2,000 monthly instead of $1,000 cuts your timeline roughly in half. What takes 25 years at $1,000 monthly might only take 13 years at $2,000 monthly. But here's where most people get this completely wrong. They try to increase their savings rate by cutting expenses across the board, which usually leads to misery and eventual failure. The smarter approach is focusing on the big three expenses that dominate most people's budgets. Housing, transportation, and food typically account for 60% to 70% of household spending. Small optimizations in these areas create massive savings without feeling like you're depriving yourself. I watched a client reduce his timeline to passive income by 7 years, simply by moving from a luxury apartment to a modest house with a roommate. His housing costs dropped from $3,200 monthly to $1,800, freeing up an extra $1,400 for investing. He didn't feel like he was sacrificing his quality of life, but that single decision accelerated his wealth building dramatically. The transportation piece is where I see people make the biggest mistakes. They'll finance a $60,000 truck while complaining they can't afford to invest for their future. Meanwhile, a reliable used vehicle could free up $800 to $1,200 monthly that could be redirected toward building their passive income foundation. That monthly car payment difference, invested consistently, becomes worth hundreds of thousands over time. Here's something that might change how you think about reaching your passive income goals. The traditional approach focuses on accumulating enough capital to live off the returns. But there's another path that requires significantly less upfront capital. Instead of needing $600,000 to generate $2,000 monthly forever, what if you needed a smaller amount that you gradually spend down over 20 or 30 years? Look, I know these numbers might feel overwhelming, but here's the truth that nobody wants to talk about. Building real passive income isn't about finding some secret strategy or magic formula. It's about understanding the math, making realistic plans, and staying consistent for years or even decades. Whether you need $400,000 or $1.2 million to generate that $2,000 monthly depends entirely on your strategy and risk tolerance. But pretending you can do it with pocket change is just setting yourself up for disappointment. The people who actually succeed at this aren't the ones chasing the latest passive income fad. They're the ones who pick a reasonable approach, educate themselves relentlessly, and stick with their plan even when it gets boring. Your future self will thank you for starting today, even if the timeline feels impossibly long. Because the only thing worse than taking 20 years to build meaningful passive income is looking back 20 years from now and realizing you never started at all.